Let's just dive straight into this explainer. We're setting up what is arguably the ultimate heavyweight matchup in wealth creation. I mean, we're talking about one of the biggest debates in personal finance. It's a choice you, me, literally almost every single investor has to make at some point in their financial journey. In one corner, we've got index funds. In the other, active mutual funds. We're going to break down exactly how they work, what they cost, and ultimately figure out which one might actually be the right fit for your hard-earned money.
So imagine two investors standing right at the exact same starting line. They've got the exact same financial goals, the same discipline, and the exact same timeline to let their money grow. Literally, the only difference is the vehicle they choose to get there. One puts all their faith in an index fund, while the other goes all in on an active mutual fund. The big question we're tackling today is, fast forward 2 decades, who's actually going to have more cash in the bank? And, is paying a professional to manage your money really worth that extra cost?
To make this feel a bit more real, let's anchor the stakes. Let's say both of these hypothetical investors commit to putting away exactly 10,000 rupees every single month for the next 20 years. That is a serious commitment, right? And over 2 whole decades, the compounding effect of that one single monthly decision is going to be absolutely massive. The choices they make today on where to park that 10,000 rupees will fundamentally shape their financial futures. Okay, so here's our roadmap for this explainer. First, meet the contenders. Second, costs, returns, and risks. Third, weighing pros and cons. And finally, making your final choice. Section 1. Meet the contenders, defining the combatants in our wealth creation journey. Let's start with the index fund. This right here is pure, automated, passive investing. It simply replicates a specific market index, like the Nifty 50. Think of it like a mirror. If a company shifts in weight, the fund automatically follows suit. There's no stock picking, no guessing games, just perfectly mirroring the benchmark. And really, this all boils down to a core philosophical difference. The index fund just wants to match the market, just ride the wave. The active fund, on the other hand, exists for one reason and one reason only, to beat it. That single philosophical difference dictates absolutely everything, from how they operate to how much they cost you. Which brings us to our second contender, the active mutual fund. Here, the process is incredibly hands-on. You've got professional fund managers backed by entire dedicated research teams. They're constantly out there meeting with company executives, studying industries, analyzing macro conditions, and aggressively tweaking their portfolios. Their entire goal? To pick specific stocks they genuinely believe will outperform the benchmark index. They aren't just buying the whole haystack, they're actively hunting for the needles. Moving on to Section 2, costs, returns, and risks, running the heavyweight gauntlet. Now, here is where all that effort directly translates into cost. Every mutual fund charges an annual fee, called an expense ratio, just to keep the lights on. Because index funds are automated, their fees are, microscopic. But active funds? They charge much higher fees to pay for those massive research teams. I mean, Wall Street certainly doesn't work for free, right? And look, while a 1.5% difference sounds tiny on paper, over 20 or 30 years, that tiny fee can silently swallow up to a third of your total potential wealth. It's a huge deal. But wait, higher costs might actually be worth it if you get higher returns, right? Well, that's the million-dollar question. Can fund managers consistently beat the market? The data tells us that yes, while some skilled managers absolutely do outperform benchmark indices during certain phases, a lot of them really struggle to do it consistently over long periods, especially once you subtract those higher fees we just talked about. Index funds give you consistent market returns, minus a tiny tracking error. Active funds give you the potential to outperform, but identifying exactly which manager is going to pull that off over the next 20 years, that is incredibly difficult. So let's talk about what can actually go wrong. Active funds carry a few totally unique risks. Because a human is pulling the levers, you're exposed to human error. You've got fund manager risk, stock selection risk, and style risk. What if your star manager just quits? What if their research is flat out wrong? Or what if their specific investing style just falls out of favor? The reality is, there's a very real possibility your active fund could end up underperforming the basic benchmark. Now, to be perfectly fair, let's keep the scales balanced here. Index funds are definitely not a silver bullet. They still carry fundamental market risk. If the whole market crashes, your index fund is going down right along with it. There's no smart manager sitting there ready to move your money to safety. You are fully 100% exposed to market declines. Plus, there is a tiny tracking error, meaning the fund's returns will always be just slightly below the actual index because of its own operational costs. All right. Section 3. Weighing pros and cons, the ultimate visual scorecard. Looking at the advantages, index funds really shine when it comes to simplicity and low cost. They're highly transparent. You always know exactly what you own, and your success isn't riding on one manager having a hot streak. But flip over to the active fund side. They offer the ultimate golden ticket, the potential to actually beat the market. Plus, they offer flexibility. A savvy manager can help mitigate downside risk during a recession. Active management is also historically super useful in inefficient markets, like small caps, where really deep research can uncover hidden gems that a totally automated index would just completely miss. On the flip side, though, the disadvantages are equally stark. The most fundamental reality of an index fund is that it guarantees you will never, ever beat the market. And like we said, you're going to take the full brunt of every single market crash. Active funds, however, drag down your baseline returns with those higher fees. They can suffer from wild performance inconsistency year over year, and they require you, the investor, to periodically check in on your portfolio to make sure your chosen manager hasn't lost their touch. And that brings us to Section 4, making your final choice, aligning strategy with your personal goals. So, what does this all mean for you? Who should actually choose what? Well, if you're a beginner, a long-term passive investor, or honestly just someone who wants to grow their wealth without spending their precious weekends staring at financial data, index funds are probably your best bet. They give you broad exposure with minimal effort. But if you're someone who doesn't mind researching fund performance, you're totally comfortable reviewing your portfolio regularly, and you really want that extra alpha, that chance of outperforming the market, then a carefully selected active fund might just be the tool for you. But hey, here's a little secret. You actually don't have to choose just one. A lot of experienced investors use a hybrid approach, often called a core and satellite strategy. Basically, they build the core of their portfolio with super stable, low-cost, large-cap index funds. Then, they use active funds as satellites for mid-cap or small-cap exposure. Why? Because those are precisely the areas where active management actually has a historic track record of finding market inefficiencies. It's kind of brilliant. You get to combine the low-cost benefits of passive investing with the targeted firepower of active management. Now, whichever path you end up choosing, you've got to avoid these common traps. First, stop chasing past returns. I can't stress this enough. Last year's winner is rarely next year's champion. Second, do not ignore expense ratios. Also, stop switching funds every time the market panics. And please, never invest blindly without a clear goal in mind. The most crucial takeaway here is summarized perfectly by this quote from our source material. Every rupee saved in costs stays invested for you. Whether you go the passive route or the active route, you absolutely have to be mindful of the friction your money experiences. Over a 20-year timeline, minimizing unnecessary costs is quite literally one of the few guaranteed ways to boost your overall returns. Ultimately, the best investment strategy isn't about agonizing over finding the perfect, flawless fund. It's about staying invested, remaining disciplined, and trusting the process over decades. At the end of the day, consistency matters so much more than perfect market prediction. So, taking a hard look at your own financial goals, your personal risk tolerance, and the actual time you have available to manage your money, are you an index fund investor or an active fund investor? Think about it.